Hello and welcome everyone to another weekly market commentary from StashAway. With us, of course, our Chief Investment Officer, Freddy Lim. Hey, Freddy, how are you?
Hi, Philipp. Good morning.
Yes, how are you doing?
I'm very well. Friday tends to be a good time for reflections and review of a lot of matters. So
Yes.
I tend to enjoy this day.
Exactly. And we have a few things to review, right? A few things happened since last week's weekly market commentary. And I think we want to hit on a couple news items. And again, we got quite a good amount of questions. So for anyone who is first-time listener here, please feel free to put the questions in the comment section below the video so that we can get to them over the next few weeks. So Freddy, one of the news items of the weeks that got released just recently, obviously, was the Singapore adjusted unemployment rate increase by about 1% almost. So we're currently sitting at about 4.7% in the unemployment rate after Q3. How do you think this is trending, and where do you see this going, especially for when we look into going into 2021 now?
Well, the increase in unemployment rate is a confusing one for a lot of people. Actually, if you just look at the component of this number, you realize that the amount of unemployment has gone down, meaning employment, and in particular resident employment, has staged a strong rebound in Q3. What happened is that the decline in unemployment is offset by the denominator. So as you know, unemployment rate is number of people unemployed divided by number of people who's able to work and actively seeking jobs. And as we head into from phase 1 to 2 to 3 in Singapore, relaxing measures, people are actually actively trying to come back to the workforce again. The base, the denominator in the equation has gone larger. So lower unemployment number of people, but divided by a larger base of people who are seeking jobs, the labor force is the number has grown. You end up with a higher unemployment rate. That's a technicality. In actual fact, resident employment has rebounded to a level that's almost back to pre-pandemic level. So that's actually a very good optimistic point to make.
Yeah, so good, some optimism in this world. I think with combined with the vaccination starting, I think people feel like, hey, 2021 could be really a much more opportunistic and better year, right? Yeah. With that being said, one of the asset classes has been doing really, really well, and it doesn't seem quite like 2017, Freddy. I know when we first took a look at this, but Bitcoin, obviously, we do want to talk about it. A lot of people are very excited about it. New all-time high, broke 23,000, I think, at some point this week. What is your opinion about it? And people are asking us, of course, always, how do I get access to it? Should I invest in it now? Right? What's your point of view on that?
Firstly, to explain what flows are driving the surge. You've seen a lot of talk about dilution of paper money because of the massive amount of stimulus done by central banks and governments around the world. And that fear of the dilution of money has driven a lot of individuals to start packing money in gold and digital gold, right? That's the usual argument. And however, the real thing is that when some institutions are starting to actually dedicate some percentage, a small amount of their total assets into it, but this asset class is so vulnerable to flows, right? Inflows, outflows. So it exacerbated the upsurge, and you can say it's sentimental, but the result is actually driven by a fear of the dilution of paper money. However, I would caution investors from their own FOMO right now, the fear of missing out. Something that's such a lot, and typically of Bitcoin and in this space, it can also go the other way. So always make sure you rebalance your portfolio, you keep your allocations in mind. If you had 10% of your net worth in Bitcoin before, now it's surging a lot, it's time to do some rebalancing, right? But also very, very another word of caution as well is that as in 2017, during last time the old high, we've seen because a lot of non-savvy investors who's you don't have a cold wallet or you don't have an account with Coinbase or whatever, you're buying it through ETFs or index fund. or when your 401k or pension funds allow you to do so through those ETFs, actually that's also a recipe for disaster. Because back then, I remember, I don't know if it's GDC, but it's one of those Bitcoin ETFs, tracker fund, were trading at a 40% premium to the underlying Bitcoin holdings. And this time we see the same thing again. We see the Bitwise 10 crypto index fund trading at 396 percentage point in premium to the underlying. That's is quite extreme, right? In a sense. So I think I do want to caution investors from keeping the FOMO in check, and also when you are doing it through an index fund format, do know that there's a huge tracking difference. Keep that in mind.
Absolutely. The other news that came out, Freddy, was obviously, as we've been following also over the last couple of years, Donald Trump, it put everything a little bit more in the spotlight when it comes to the trade war, as well as, the currency manipulation. We talked about this before, but this week, the US tagged Switzerland and Vietnam actually as currency manipulators, and kept China as one, and added Thailand, Taiwan, and India for the watch list, right? So yes. Maybe you can explain really quickly, what does it actually mean, that label of currency manipulator, and then what is the impact of that going forward? Yes,
by law, that label requires the new incoming president, the administration, to engage with those countries to address the perceived FX imbalance. And penalties, including exclusion from US government contracts or work, could be applied after 1 year, unless the label is removed. And also bigger consequences could be if the Commerce Department initiate some counteracting duties like tariffs against the respecting countries and industries. So that is on paper, right? Now, under Donald Trump, it's really used as a leverage in trade negotiations, as we know, like when he did it against China and even against the EU, right? Now, if you look at the incoming Biden administration, Janet Yellen, former governor, actually a former head governor, chief of the US Federal Reserve, is going to be the incoming US Treasury Secretary. Steve Mnuchin is going out. And so what we've seen is that Janet Yellen is very sympathetic to those countries, in the sense that she understands that smaller countries who does not have a huge bond market or money markets, they have a limit in terms of how much they can do in monetary policy. Same as Singapore. And what happened is that FX policy is often used as a way to achieve monetary policy purposes. And in this case, in Switzerland, it was the same. In Vietnam, it's the same. Switzerland don't have a very huge domestic bond market, and they rely on FX policies and FX reserve and then they use those reserves to buy assets in the US, for example, right? So that actually, she's sympathetic that the line is not well understood by politicians. And as incoming Treasury Secretary, right, I think she would not really make a big deal out of this currency labor. I think it will be nothing more than a knee-jerk reaction.
Thanks, Freddy. Let's get to the users' questions. Let's go straight away to the first one. It's Yao Bin 10. He's saying, I've been investing in StashAway for almost a year now. While I'm trying to promote to my friends, I have always gotten feedback concerning if StashAway closes shop one day, what would happen to my investments? And I think that's basically the question, so I don't need to go any further. But
yeah, it's a good question. It's a good question. And it's people should ask that before they invest in any platform, right? And so the answer is this. StashAway is licensed at the CMS retail fund management level. It comes with it a lot of requirements, right? But one of the requirements is that we have a custodian set up. So there will be a custodian bank. And for StashAway, let's say for Singapore users, you realize that when you send the money to the DBS trust account, that's actually a client account, and we act as a trustee. And then money comes out from that account when we want to deploy it and buy the ETFs in the market. It goes through the broker. But we actually do not allow the broker to hold those money. The custodian for the cash was actually HSBC Trust. And then when the securities is bought, the cash comes out from HSBC Trust to pay for it. And then the security itself goes to Citibank North America, the security custodian, right? So it's multiple custodian of a big bank, big institution nature to make sure it's safe and segregated from StashAway. So the short answer, the final answer to the question is, if StashAway goes under, touch wood, anything happens like that, and your money is separated from StashAway, it will be in no way be mingled, be touched by us, right? And a fund administrator will be appointed to look at the ledger, and the ledger is audited, by the way, all the time, a lot. We'll, based on the ledger, we'll start, doing sales and returning the money to the users, right? So that's a simple answer to it. It's a standard regulatory fund administration process, right?
No, absolutely. Let's go on to the next question. It's from Ritz. He's actually figured out that you have a new microphone, Freddy. So he said,
"Thank you, Ritz."
Microphone. So he's very observant. He says, ONG appears to be recovering. Financial sectors are also factoring in a strong Q4 in 2020, in Malaysia at least. Are the SRI 36 and SRI 22 portfolios geared to take advantage of that recovery?
Well, it's a good question. My answer first would be, look, you should always look at your own risk level, right? After you answer questions, profiling, and where do you belong to in terms of your natural risk tolerances. But let's say, assuming that's a given, you have done that analysis, to take risks higher than where you're supposed to be is, in effect, in this question's case, is you're trying to do market timing. And market timing does come with it a certain level of unique expertise, right? So assuming you have the expertise, yes, SI 22% to SI 36% are well-oiled for that very growth-oriented approach, right? But again, I would always default to, you should always keep in mind where your natural risk tolerance is. And there's also nothing wrong with a balanced portfolio or a low-risk portfolio. They just take longer to move, but they also do not have a lot of risk, right? So ultimately, my answer is going to be a disappointing one. The financial plans. But yes, the person is right. After all the assumptions I mentioned, yes, you can use those portfolio to
take advantage.
Position yourself.
Absolutely. And next one and last one for today, Freddy. He says, "Hi StashAway, I'm from Malaysia. I still don't quite understand the USD denomination part. Yes, USD exposure is minimum, but even with the market uptrend, my returns seem to be stagnant because USD has now dropped to 4.05. Can StashAway other denominations?"
Well, let me just quote the year-to-date return first.
Yep.
You tell me if there's no return. The lowest risk portfolio, SI 6.5% this year-to-date, between first day of the year to 14 December, up 3.4% before fees. In Singapore terms, in Malaysia terms, it's actually maybe slightly lower, like 3.1. And then the highest risk portfolio is about 20% in Singapore terms. In Malaysia, maybe a little bit lower, like 19 plus. So there is return for the year, but the problem is, depending on when you started investing in the platform, if you have invested in the last quarter, where before the U.S. general election, there were a lot of uncertainties and whipsaws, and you start seeing very flat growth last couple of months, perhaps, and then the currency fallen, you felt like, oh, maybe that has given me a negative return, but that's not true, because back in May 14. This year, StashAway's algorithm has re-optimized portfolios, and we have minimized US dollar exposure. And the portfolios are only denominated in US dollar because the ETFs are listed in US exchanges, but it's not really exposed to US dollar. I have to just emphasize that again. So a good example is if I have Asia ex Japan and it's listed on the NASDAQ and it's quoted in US dollar because it's in the US exchange, but the underlying asset classes are 40% China, right? South Korea, maybe around 13%, Malaysia is 5%, Singapore 5%, right? It's nothing to do with US dollar. If all else constant and US dollar goes down, the NAV of the fund will go up to provide a neutralization right? If all else constant. And vice versa, if the US dollar goes up, you can see the price of the ETF actually come down if nothing else moves. So it's just that because we don't see this being separated from the underlying Chinese movement, Malaysian assets movement, you don't see that. You only see the NAV in dollars. You get a feeling that, I'm losing money because of US dollar. But actually, it's a time when the market is pretty flat, and you may actually be slightly down, and you felt like it's because of US dollar, but it's not true.
Great, thank you, Freddy. I think that was, I think we covered it last time. So if you also didn't listen to this US denomination topic last week, we already kind of touched on it. So Freddy, this is a great follow-up. So for everyone who wants to learn a little bit more, listen to last week's episode. For everyone else,
Philip, I feel like we need to mention one thing. Sorry to interrupt you.
No worries.
Like I just said, the last quarter could be flat, but if I just quoted the year-to-date return numbers, right, and the pandemic year, 3.4 percentage point in Sing terms to 20 year-to-date. And I felt like, and if you look at our past year's average, we always average around 3 to 15 percentage point on an annualized basis since launch. So it's sort of like, what it's trying to tell you is don't look at quarter to quarter or month to month. Even 6 months is too short. You just really need to take a long view and let that numbers, the averages, the compounding come in and let that take over. And don't try to be too timing the market too much, right? And the algorithm does it over time. It gets better, but the return will you start seeing it. So I just want to remind users to stick to the financial plans and take a longer view on that.
No, absolutely. I think that's great advice. So thanks, Freddy, for this. For everyone else, there will be no webinars until January. So in January, back with webinars. But if you want to learn a little bit more about personal finance, entrepreneurship, we had a great episode just released on our other podcast, which is called In Your Best Interest. So you can find it on Spotify. We'll probably put this in the show notes below. There, I got to enjoy the time and interview a person who achieved financial independence very early on in his 40s. And so he's enjoying life now. He's sharing a little bit about, what that life is like, how he got there, and things like that. So if you want to learn more about this, go check out In Your Best Interest as well. Otherwise, Freddy and myself will be back with you again next week. Until then, have a wonderful rest of your weekend ahead, and we'll speak to you again soon. Bye-bye.
Yeah.
Subscribe to our YouTube channel to get notified whenever we have new content out for you. Also, don't forget to download the StashAway app. It's available in the Apple App Store as well as the Google Play Store. So you can start on your financial journey right now.